Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And yesterday, which was Wednesday, November 4th, we had really kind of a crazy market, and that market seems to be transferring today. Kind of counterintuitive considering what's going on with the elections right now. But nevertheless, we had some really surging stock prices. And what I did was here, I highlighted 5 companies that I have a long position in that are healthcare stocks. And what I'm really doing here is trying to offer you some lessons, what I call lessons in valuation, because I consider all of these 5 companies very strong companies. They are currently trading, I think all of them are worth at least 15 times earnings or more. They all, have earnings yields above my 6.5%. One of them is a growth stock. Otherwise, I've got, some decent dividend paying stocks. I could actually argue that Anthem would be another example of a relatively moderate or low yielding, more growthy stock. But Bristol Myers, AbbVie, and even Amgen are certainly, good high quality dividend growth stocks. 4 of the stocks are A rated or better, A minus rated or better, and 1 is triple B plus, which is just 1 notch below A. So I'm going to go through these in alphabetical order, and all I'm trying to do here is point out what I consider to be some important lessons about valuation. Number 1 is valuation is all about being able to invest in a business below its intrinsic value, or as some people like to call it, its true worth. However, before I get into that, let me kind of define how I see that a little bit. Number 1 is this orange line on the graph is a valuation reference line. It's theoretically should be thought of as the midpoint of a small range of valuation. That could be, in this case, I'm using a 15 PE ratio on AbbVie here, 15.1, 15.08. You could think of it as 13 or 14 to 16 or 13 to 17, depending on how liberal you want to be with valuation. But this is also a graphing of the business success, how well the company has grown its business. And you could see here, notwithstanding the first year, that AbbVie has grown their business at over 15% a year since it was spun off from Abbott Labs. The white line is the dividend. The dividend growth has also been very consistent and very attractive. And this is the business behind the stock. When I put the stock price on this graph, you're going to see this in other examples. For the first 4 years or so, AbbVie was trading within what I consider to be this theoretical fair value range. And then with healthcare reform and the opioid epidemic and a lot of other things that happened, a lot of healthcare stocks became out of favor here over the last couple of years. In other words, they are trading at these low valuations. Remember, this is 15 times earnings. This is 10 times earnings, 8 times earnings. Currently it's trading at a blended PE of 9.23 times earnings. I believe the stock is worth something around this 15 valuation. So that would say, mean to me that by year end, I think this stock has a value of $158 a share, and you could buy it for $94. Now, it had a nice little pop yesterday, as I pointed out in the written portion of this article that goes with this video, but it's almost indistinguishable from the day before. In other words, this stock is still very undervalued. So this tells me about how the business was, and I tend to like businesses that have consistent growth like that. This is a high quality company, and it's had great operating results, and the operating results have continued to excel despite the fact that the market has been undervaluing the stock, which is one of the main messages I have. Now, I always buy the future, never the past. And so as I look forward over the next couple of years, analysts expect double-digit growth in 2021 and 2022. There are 19 analysts for 2021 and 16 analysts for 2022. Now, I also want to point out that 6 months ago, estimates were lower for 2021. They were $10.48. Today now we're up to $12.20. 3 months ago they were $12.15. Next year, 2022, which has less analysts, gets further out, these estimates have stayed pretty consistent. So my point is we've got a company that actually theoretically is getting more favorably thought about by analysts than it's been in recent times. The forecast has actually increased substantially on this stock, and yet the price continues to languish down here. My point is I trust the orange line more than I do the price line, which is obviously very jagged. I consider the stock very undervalued. I'm going to do these in alphabetical order just to save time. I can just go through my little portfolio here. And the next one I want to look at is Amgen, the world's largest biotech company. I wanted to show this example for a couple of reasons. One is this was a quintessential long-term, biotech growth company for many years. Going back to 2011, it started paying its first dividend. But I do want you to notice, like I saw with Abbott, it has a very consistent long-term history of growing its business. If I go back all the way as far as I can, we see a period going back almost 20 years here where you have year after year very consistent growth. And we actually have a little surge in growth when they started paying their dividend, and we've got a dividend that has grown consistently. Now, I also want to, since this is about valuation, I want to talk about valuation. This was a very overvalued stock coming into the recession of '01, and it stayed overvalued even as we came close to entering the recession of '08 and '09 here, which is when it finally got undervalued. But then since that time, I do want you to notice, since the recession ended, the stock price has really tracked the orange line. This is exactly what I like to see in a stock. This is what makes me happy. There's no stress when you own a stock like this, where you've got strong fundamentals and strong earnings. Amgen was slightly undervalued prior to yesterday. They had a nice little surge in price, but I think the stock now is actually fairly valued, not undervalued, and does offer some intriguing double-digit rates of return going out for the next couple of years. My next example is Anthem, a managed healthcare company. It has also pretty much tracked the line, but you can see that when you can buy these stocks at low valuations, they're really opportunistic, times to buy it. Your rates of return, here we've got a company growing by 12%, but if I bought it back here at a 10 PE, and now that it's fairly valued, I would expect a 12.6% rate of return plus dividends based on just how the earnings have grown here at the 12.6%. But what I get instead is I get actually precisely an 18% rate of return, because I've gotten, in addition to 12.6% growth, and this is the real beauty of buying at value, I don't only get the 12.6% growth, but I also get the PE expansion from 9.57 to just under 15 to the current blended PE of 14.94. And then on top of that, I get a little dividend income as well. This has been a tremendous investment over this time frame. But once again, we see a very consistent earner here. My next is Bristol Myers. This is kind of interesting. This is obviously a large pharmaceutical company, A+ rated, 44% debt, which is good. And it's a company that's kind of got resurging growth. Now, if I look at this stock long term, as I did with one of the earlier ones, you'll see, again, a period of high valuation, poor time to buy the stock. But I want you to notice the flatness here, a period of several years here, almost more than a decade, where the earnings really didn't do very much. It earned $1.68 in '03, and it only earned $1.84. It had grown to only $1.85 by 2014. Then it started surging again, and the price kind of got pretty highly valued. Once again, something spooked the market. The price got undervalued. It's undervalued today. It had a nice rally yesterday, but I do believe this stock is extremely inexpensive, has about a 2.75% dividend yield over a 9% earning yield. Again, it's A+ rated, has moderate debt at 44%. This is an excellent opportunity to buy a good growth situation with a very attractive dividend kicker. The next company I'm going to look at is a pure growth stock in the healthcare sector, and I wanted to include this one because you don't get the benefit of the dividend, the comfort of the dividend. Now, they do pay a very little dividend. If you look at this, if I go to the performance report, you'll see that their dividend payout ratio is less than 1%. It has been for many, many years here. There was a time back in 2003 and 4, as you can see here, that it paid a pretty nice dividend yield. But this has been all about capital appreciation. And the company's grown earnings at about 11% a year. Right now it's got 11.48 PE. So if I find a time when the stock was trading close to that, here's a 12.1 PE, and I held it to today, I'd have averaged over 27% a year. In contrast, if I'd have bought it just before the recession really hit, my rate of return would have been closer to the 11% that the company's generated. So valuation makes a big difference. This is a very attractive growth stock, A- rated, 37% debt. It's forecast to continue growing at double-digit rates over the next couple of years. This offers you some PE expansion with growth, generating total returns that can be very attractive. But once again, the risk here is everything that you're looking at is based on the growth potential. So there you have it. You have 5 very attractive companies: AbbVie, Amgen, Anthem, Bristol Myers, and Cigna Corp in the healthcare sector that have been really undervalued by the market. And, if we do get, with this bifurcated market, if we do get a switch from high-tech growth to value, these are the kind of stocks that are going to do well. The key is that all of these companies have strong fundamentals in spite of the fact that their stock price has been low. Anyway, I hope you enjoyed this. You might want to take a look at our Dividend King service, where we talk about all the companies you see in this list, with the exception of Cigna, are covered there. It's a marketplace service here on Seeking Alpha, and I appreciate your watching. Thanks.